Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. I hope you're all enjoying your weekend. I am still on business, unfortunately, and so the audio quality is once again a little bit suboptimal. There's also some construction near where I'm working, so there may be occasional banging from time to time. My apologies again in advance. It should be fine, however, for the majority of our needs in this video. So let's just jump in. And first up, in a sign that Beijing may be seeking a more balanced approach to its zero-COVID policy, a theme signalled by the Politburo Standing Committee on Thursday, and despite, or perhaps because of, surging COVID cases this week, yesterday, Friday afternoon, the State Council's COVID-19 prevention team announced a series of 20 easing measures. These are quite moderate relaxations, positive initial steps towards an eventual border reopening at some point in the undefined future. But we should view these as they are, tweaks to the existing zero-COVID, not rollbacks. The newly released measures include ending the practice of cancelling international flights if too many passengers from previous flights test positive on arrival, which should allow more international flights and reduce prices. Arriving travellers will now be allowed to enter China after showing just one negative PCR test within the 48 hours before boarding. The threshold for a negative test will also be reduced from 40 to 35. The length of time spent in central quarantine for close contacts has been reduced to 5 from 7. Close contacts of people who have been in close contact with someone else who tests positive will now no longer have to undergo quarantine and medical supervision. Risk area classifications have also been tweaked for cities. In a big change for domestic travel, residents travelling domestically from high-risk areas to other parts of China will now be required to spend 7 days in home isolation rather than in a centralized isolation facility as before. Several other measures were announced too, touching on different areas of the COVID prevention industrial complex, including adjustments to mass testing rules intended to improve efficiency. Greater vaccine adoption will also be promoted. The market reaction to the amendments to zero COVID was swift. Almost all major commodities traded higher following the move. Zinc jumped as much as 6.4% on the London Metal Exchange, while aluminum was up 5.4%. Oil futures in New York and London added as much as 3.6%, while iron ore traded in Singapore soared 5.3%. Of course, these rallies were helped by a rally that began in North America with the release of lower-than-expected inflation data, easing the cost on the US dollar, with this helping commodities priced in the US currency. The market seems happy, but analysts continue to warn that investors should not be premature, as despite these relaxations, zero COVID is still very much in place. Okay, next up, and our main theme for today's episode, the banking system of China. This week, Bloomberg's Hong Kong team writes that pessimism about China's banking sector has reached, quote, an unprecedented level, even approaching the depths at which US lenders traded during the 2008 financial crisis, end quote. The outlet's analysts point out that shares of the 4 biggest lenders, including Industrial and Commercial Bank of China Limited, are priced at near record low valuations of about 0.4 of book value in Hong Kong after the sector index weakened to an 11-year low. Quote, that depressed level roughly matches where investors priced JP Morgan Chase & Co. and Bank of America Corp., among others, during the depths of the 2008 crash, end quote. While bank earnings have been steady so far, the twin risks of zero COVID and the property crisis remain ever present. Quote, while we haven't yet witnessed any signs of a structural deterioration in the domestic economy, it's likely to remain under pressure in the next few years amid a global recession. Banks would be more stressed if they can't recover the loans by then, end quote. Analysts are also concerned about the poor performance of state-owned banks in particular, and the higher risk that investors are pricing into bank shares. Quote, Chinese banks are more prone to any increase in risks associated with the GDP growth. their net margins could further narrow as banks plan bigger provisions for bad debt and continue to cut loan rates to support the economy." End quote. Analysts at Bloomberg Intelligence said that it will be hard for banks' shares to achieve any quick turnaround, writing this week, quote, "Valuation prospects could only stabilize on a reversal of market perceptions around China's country risk," end quote. And like so many Chinese economic issues this year, it all ties back to the ongoing housing crisis, an industry touching 20 to 30% of Chinese GDP. Quote, "What matters more is not how much of a risk there might be for banks today, but rather where the property market is going in the long run. If the property market remains sluggish for much longer, it will certainly impact demand and quality of other loans." End quote. Now, this was already the concern of analysts earlier this week, but there are now even more pessimistic signs for the Chinese banking system. Hey guys, if you like what I'm trying to do here with China Update and you'd like to help me keep it sustainable, Patreon and Buy Me a Coffee links are in the description below. This is the primary channel of support for me to continue making these episodes, so it is a massive help. If you enjoyed today's episode in particular, don't forget to hit that like button, and as always, thank you so much everybody for the ongoing support. Now let's continue with the Chinese banking sector. According to official numbers published by the People's Bank of China this week, aggregate financing, also called social financing, the broadest measure of credit in China's economy, was 908 billion RMB in October, well below the 1.6 trillion RMB recorded in October of last year. Quote, "It looks quite worrying for private sector demand and that the telltale signs of a liquidity trap persist." End quote. The October credit expansion was even worse when observed month on month. Quote, "October is never a strong month for credit growth in China, but this year, despite pressure from regulators on banks to expand credit to the private sector, aggregate financing in October grew well below expectations, being barely a quarter of September's figure. This brings total aggregate financing this year to 341.6 trillion RMB, an increase of 9.1% over 2021, or 11% annualized. The 28.6 trillion RMB increase this year is equal to just over 29% of China's year-to-date GDP. This increase in debt of 29 percentage points of GDP will deliver about 6 percentage points of nominal GDP growth. That's a lot of debt for so little growth, especially when much of this growth consists of the low-quality growth from which Beijing is trying to get away." End quote. Pettis continues, quote, "China's credit growth has slowed sharply in recent months from very rapid growth in the first half of the year, and while this should be a good thing, in fact GDP growth has slowed even more sharply. The pace at which debt grew may have slowed, but the economy's dependence on debt actually increased. My best guess is that China's aggregate finance will rise from 274% of 2021's GDP at the end of 2021 to 289% of 2022's GDP at the end of this year." End quote. The central bank data also show that Chinese banks extended 615.2 billion RMB, approximately $84.86 billion US, in new yuan loans in October, down almost 75% from the 2.47 trillion RMB in loans in September. Quote, "Much weaker than expected credit growth and an extremely unusual outright fall in lending to households again underlines the difficulties policymakers are facing stimulating growth while activity is suppressed by zero COVID." End quote. The M2, a broad measure of money supply that covers cash in circulation and all deposits, increased 11.8% year-on-year to 261.29 trillion RMB at the end of last month. While these are all of course very concerning red flags for the Chinese economy and the banking system, very smart analysts continue to remind us that crisis means damage and pain, but not necessarily collapse, and as such we should manage expectations. Quote, "We see current circumstances as a slow-moving financial crisis. I do think crisis is a reasonable description today. Activity is down so much more than policymakers intended, and they have not been able to alter that. This is not under their control. The probability of a hard landing is higher now than in the past. Beijing used to be able to smooth over contractions, provided it was willing to expose itself to even more debt risk in the future. Current conditions can probably be described as a hard landing. We have essentially 0% growth this year, which is unknown in the Chinese context. Should we be concerned that it might not land at all, but it might be a crash, followed by a lost decade or something like that? I think those are possibilities, and they are being considered. Are there things that Beijing can do that would stabilize the outlook? Yes, there are. Although I don't think they can both stabilize the outlook and have a rebound in 2023 at the same time. They are going to have to accept a couple of fellow years in order to get things back on track, and they'll have to accept political reforms which to date have been a bridge too far. End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful weekend, and I will see you all back here with China Update on Monday.